Good evening, everyone.
Hi Vivek sir, how are you?
I'm I'm good, Lakshay.
Good evening.
Vivek sir, I have a lot of doubts today. I analyzed couple of charts, so we'll be taking it at the end of the class maybe.
Yes, yes.
Good evening, Vivek.
Good evening, Vivek ji. Good evening.
How are you feeling now?
Yeah, better now.
Good.
Better
Good
now.
to see you.
Thank you.
Vivek sir, is it after the trip you had and you uploaded the vlog that you caught fever?
So what?
I don't know what happened. Generally, I don't get sick. Uh, I have a good, strong body, but still, I got sick. It has happened, but I don't remember last time. See, it was 2 years back when I got dengue fever. And before that, it was 13 years back when I had fever. So in last 15 years, only 2 times I have got fever.
Okay. Vivek sir, I wanted to ask a question before the class starts. So you talked that you work for 100 hours a week, and even I want to match that level of productivity inside me, because like I have to match my job as well as trading as well as physical activities. So in that case, can you give some tips on the health front? How should one, approach that?
Health will never be a problem till the time you will be eating right and drinking right. That's it. Health has 99% to do with the eating habits.
Yeah.
And very less to do with the workout and all.
Yeah.
So if we are eating right, then health means this physical body will be supporting us throughout the life. Okay, one more sentence all of you can note down is jitna chaloge utna chaloge. If you could understood this, then well, otherwise I will explain in English. So jitna chaloge utna chaloge. So the more you will walk every day, the more number of years you will have in your life. This is so simple. More you will walk, more you will live. After 65 years of age, none of us means the people those are above 65 years of age do face any problem with the upper body. They are not facing any problem with the upper body. They are facing a problem with the lower body. They are unable to walk. And why? Why? The simple reason is we are using this chair and we are fighting for this chair means at home, in the office and everywhere. So this chair is the problem. This chair is the problem. This chair is the problem for physics, for mental health, and for relationship. For everywhere, this chair is the problem. We should spend some time on daily basis sitting on the floor, at least half an hour. And we can make a routine. We can make a routine like whenever we will have coffee or tea with family, we will be drinking it sitting at the floor, not on the bed, not on the sofa, not on the dining table.
Sir, what's the rationale behind it? How does it help?
See, this part of the body, this one, it is being hit every day by chair. And that creates a lot of problem.
Yeah.
It is means we are losing the strength of the glutes. And in the glutes, there is a bunch of all the nerves. And that is weakening every day when we are sitting on the chair. We need to take care of it. We will talk about it at some other time. I have a friend, Mittal Singh, who is the world champion in bodybuilding. So I will get a session with you guys. I will request him to spend 15-20 minutes with you. Okay, so he will better explain each and everything. He is the master of physics. He is the master of physics. I have not seen such a guy in my life who understand each and every millimeter or means each and every particle of the body with so much of depth. He's a master in that. As I do understand a lot about stock market, he understands each and everything about physical body. And means when I had first met him, after that my life has totally changed. He has transformed everything. Otherwise, I used to be 98 kg. I'm 77 now.
So, sir, what is your height?
I'm 6 feet. Okay, so it depends on us. I used to use the secret book in my day-to-day life. I do manifest, I do visualize, I do write down what I want from this life, and finally I get it. So the secret book is one of the most important book in anyone's life. We are ignoring that. And I have heard from many people that I had bought this book almost 10 years back, 5 years back, but never read it, never tried to implement it. I will say buy it, read it, implement it, and you will get what you want. Anything what you want. When I'm saying anything, means anything. Even if you will be wishing that Aishwarya Rai should be in your home, she will come down. Seriously. So reasons will be created. Reasons will be created. We need to just follow the learning given in the secret book. And there is a complete movie on YouTube in Hindi as well as in English, and that is only 40 minutes long. I have watched that movie almost more than 40 times. I have read the secret book more than 40 times. So that is in my subconscious mind. So anything I do wish about, I never said that this is my target, that my target is to achieve 1,000 crore, 10,000 crore or $1 billion or $10 billion. No, I don't have any target. All I have is the wish. So when I'm using the word target means it becomes my arrogance that I will achieve it no matter what. No, we should not. This is not the right manner to ask for anything from the God. The right manner is, hey Ishwar, please give me this. I want this. This is my wish. Please give me this. So this arrogancy should not be in our head that I have done MBA from IIM, I am from IIT, I am VP in that company, I am CEO of that company. If I will not be able to achieve this, then who will? No, that is not the right approach. The right approach in front of God is, we are your kid, I am your son, please give me this. I wish for this. And that's it.
Sir,
right. Yes.
Sir, from the past 2 years, even so in my childhood, I had a
We will complete this.
Sure.
This is 8 or 7 now, and
Sure.
let's complete the session first, and at the end of the session, then we will be talking on this point.
Sure.
Right?
Definitely.
Yes. So this is the session for understanding the financials of the company. Right, financials plays very important role, and there are three dimensions to analyze everything. One is the business analysis that we had understood in the first session, more or less, that how should we have a look at the low penetration and how to search everything on Google so that we can understand that in other countries, how many percentage of people are using this product and what is the percentage in India. So that is the simplest way to understand everything. And then after finding the right business, next approach is to find out the right company having a good, strong balance sheet and having the right financial ratios in the balance sheet and P&L statement. Okay, so that is called the financial analysis. A lot of people are calling it fundamental analysis, but I would say fundamental analysis means the business analysis as well as the financial analysis. Simply to say that financial analysis is fundamental, no. In stock market, I have seen a lot of people, those are trading in the market for last 10, 12, 15 years, and they are making money as well. They are teaching on YouTube. They have written the books as well, but they are ignoring business analysis. Business analysis is the first analysis we should complete. If there is no scope left in any business to grow in the future, then balance sheet alone cannot give us any benefit. Right. So first of all, we need to have the opportunity to grow in the market in our human life. Then only a good company will be beneficial for us to give us opportunity based on the technical analysis. So the third part is the technical analysis. Financial analysis, while doing financial analysis, a lot of people are doing a mistake means they are trying to become a chartered accountant. They are trying to understand each and every accounting entry. We don't need to become a chartered accountant, right? We don't need to understand that why this industry means every company of this industry is paying 25% income tax, and why another industry means every company of another industry is paying 15% income tax. We don't need to go for that. Right? We just need to understand if all the companies are paying like this or not. For example, if we go to screener.in and we go to LIC, Life Insurance Corporation, and we move down to P&L statement. So what we see is tax rate is 74%, 75%, 74%, 72%, 73%, 66%. I have not seen such an income tax rate in any other company. I have not seen more than 70% income tax rate consistently every year. I have not seen before. But because this is the same rate almost every year, so it must be according to the income tax rules. Right? So the means difference could have been in just 1 year. It could be odd if in a year this is 10%, in another year this is 30%, in another year this is 40%, then coming back to 5%, then we must have to think about it. But when this is 75% every year, means it should be according to the rules. We don't need to go deeper into that. There is no use of that actually. So when we are looking at a number that is after income tax, then we need to have a look at the net profit only, means after income tax. Tax rate is not important, but yes, it becomes important if the company is usually paying 25%, but in next year, suddenly it is paying 5% only. And after that, next year, it is paying 30% again. Then we need to consider that. And how do we need to consider that? I will tell you. I will take an example. I will tell you. So this is how we need to think like a business owner, but not like a chartered accountant. So if few of us are from the finance background or from the accounting background or even the CA itself or MBA finance, then we don't need to go deeper to become an accountant here. We just need to have a look at if the net profit is growing or not, if the loan amount is coming down or not, if the revenue is growing or not, if the return on capital employed is sufficient or not, if the business is doing good or not. Are you getting my point? So we must be leaving a lot of things without discussing today as far as the financials are concerned. We would be leaving a lot of things untouched because those things are not important as far as the stock analysis is concerned. Right? We will be keeping ourselves lightweight so that we can remember things those are important to discuss and analyze, and we could leave extra stuff. Okay. So the first most important thing to understand in stock analysis and financial is the market capitalization. Market capitalization is one of the most important point to have a look at always. So there are two things in the financial information. One is per share and second is for the whole company. Please note it down. Almost all financial information are available in two forms. One, per share, and second, for the whole company. Right? So share price, current market price is per share. Current market price is per share. For example, what is the current price of Life Insurance Corporation of India? This is 628. So this is per share. And what is the price of the whole company? That is the market capitalization, 3,97,241 crore. It means if we buy all equity shares from the market at current market price, then it will cost us 3,97,241. Means the formula to calculate market capitalization is total number of shares multiplied by current market price. Total number of shares means total number of shares. It doesn't mean that shares those are being held by the promoters or DIIs or FIIs or public. Total number of shares means the total number of shares. 100% number of shares. Multiply by the current market price means the market capitalization. Means if I do buy all shares from the market, what is the cost? What is the price? Market capitalization. So 3,97,000 crore, it shows us that what is the size of the company. A lot of people do consider with the current price. A lot of people have a look at the face value, that is 10 rupees. This is current market price is 628. What is the size of the market cap? That will show you the size of the company. For example, we have taken an example here, Life Insurance Corporation, where the current market price is 628. We are taking another example, MRF. The current market price is 91,000 rupees, but the market capitalization is 38,000 crore. 1/10 of Life Insurance Corporation. So when we are checking that what is the size of the company, it means what is the market capitalization of the company, not the share price. What is the price of the whole company, not the face value, not the current market price, but the size of the company itself, market capitalization. Okay. So market capitalization itself can find multi-bagger for us. Have you ever thought of it? That simply market capitalization can find a lot of multi-bagger companies for us. A lot of multi-bagger companies. We can compare two companies within seconds. Which company is undervalued and which company is overvalued. For example, we are considering here Page Industries. The market capitalization is 55,000 crore. And second company we are considering is Lux Industries. The market capitalization is 5,000 crore. So Page Industries is 11 times bigger. Page Industries is 11 times bigger than Lux Industries. If we don't check market capitalization, then how will we come to know that Page Industries is bigger or smaller? And if that is bigger, then how much percentage or how many times? We cannot come to know. So market capitalization is the only way to identify which company is bigger and which company is smaller. Now, second step to identify means second data we need to have a look at is quarterly results. The revenue is 1300 crore. Page Industries June quarter revenue is 1300 crore and the revenue for the year is 4700 crore. And Lux Industries revenue for the year is 2400 crore. It means sales wise, revenue wise, Page Industries is just twice of the size of Lux Industries. Only 2 times of the size of Lux Industries. Lux Industries revenue is 2400 crore and Page Industries revenue is 4700 crore. Are you getting a point? The Page Industries sales number is only 2 times of the Lux Industries, whereas the valuation is 11 times. So Page Industries is extremely overvalued. So this is how we need to compare that what should we sell and what should we buy. Because both of these companies have their own niche area, their own segment. We cannot say that Page Industries brand is a premium brand, so they will be much more profitable or they will be able to sell more. No, it is not like that. The general public, those are not able to buy Page Industries products, means the jockey products will not be buy jockey products and they will be buying Lux Industries or Rupa or Dollar. So they also have their own segment. They also have their own customer base. For example, if we consider 2 companies, Relaxo and second one is Bata. So Bata is a premium brand than Relaxo. We know that. Bata is a premium brand than Relaxo and Bata have a lot of premium brands. That is not the one brand. Hush Puppies is one of them and a lot more, right? But it doesn't mean that Bata is a better company because Relaxo has a good approach in villages, the rural area, where Bata is unable to sell their products. So both have their own customer base and both are doing good. And that's why there is no difference in the valuation of Bata and Relaxo. So what is the market capitalization of Bata? This is 23,000 crore. And what is the market capitalization of Relaxo? 23,000 crore. Just equal with no difference. And what is the revenue of both of these companies? Relaxo is selling 2,779 crore worth of goods in 1 year and Bata almost same, I think, 3,000 crore. So there is a difference of only 10%, not even 10%, 8-9%. So there is no difference. And that's why in the same manner, going forward, there will not be any difference in Lux Industries as well as in Page Industries as far as the valuation is concerned. So right now, why this gap has been created? This gap has been created recently during last 1 year only. If you see, during last 1 year only, this gap has been created. How? Let's see the price performance of Page Industries. Page Industries. Okay. So in last 1 year, what has happened? The stock price has gone up 26%, right? Whereas Lux Industries price has come down. How much in last 1 year? By 55%. So if Lux Industries price was also up by how many percentage? The same percentage, 26-27% from 3,800, right? So let's say if it was also up, then the price would have been almost 5,000 rupees. The Lux Industries price would have been 5,000 rupees. And if it was 5,000 rupees, then market capitalization of Lux Industries would have been 3 times. Right? It would have been 3 times. Means the market capitalization in that case would have been 15,000 crore rupees. And there was as such no gap left then. So this difference has been created just because Lux Industries management, means one particular guy in the management told his friend that results are going to come good, excellent, you can buy. And his friend bought in a large quantity immediately before the publication of these results and sold immediately after that. And he got caught red-handed by the SEBI. Right? There was a phone call as well. You are getting my point. After that, SEBI just, I think SEBI levied a penalty, a small penalty on management, and management said in a notification that in going forward, means going forward in future, we will never repeat that mistake. Please forgive us. And by doing this activity, actually management got nothing. By doing this activity, management got nothing. It was a mistake. And the management understood clearly that we should never do any kind of favor of this kind to any friend. So the impact of this particular foolishness will be over going forward in next 2 years, of course. Time will heal all these memories. And that creates the opportunity to buy a good company at 55% lower price. Whereas there is no impact in business, there is no impact in financials of the company. The only impact was momentum. The only impact was the impact on the stock price. And that is the opportunity. That is the best opportunity always. When a stock price is coming down because of external reasons, means nothing has gone wrong in the business, nothing has gone wrong in the financials, and the stock price is down because of external reasons. That is the best opportunity to buy that stock. Best means the best. You're getting a point. So this is how we need to understand the relevance of this market capitalization. The first thing we should have a look at is the market capitalization. First thing. Right? Now, one more example. We are taking 2 companies. One is Britannia, 91,000 crore rupees of company, and second is Mrs. Bector Food, a 2,200 crore worth of company. So there is a gap of more than 40 times. Britannia 91,000 crore and Mrs. Bector Food 2,200 crore. There is a gap of more than 40 times. And Mrs. Bector Food is selling everything that Britannia is selling right now, having the same reputation. English Oven and Cremia. These are 2 brands. So why Mrs. Bector Food is not worth the size of Britannia? Because of the reach, because of the lower sales, because of the low penetration, because Mrs. Bector Foods are not being sold in the villages or rural area right now, but they are expanding. So it will take some time. But we can get a clue that going forward, Britannia will be getting much more sales and Mrs. Bector Food will be selling at least up to Britannia. Are you getting my point? They will be selling up to Britannia. Means this company has a capability to become 40 times from current price. Single shot. single shot 40 times gain this company can give us. Why? Because this company is 1/40th times than the competitor, but having the same brand value. So here brand value is important. Having the same brand value. So this is how we need to identify the multi-baggers. It's so simple. Sometimes we can have a question in our mind, Vivek bhai, is it so easy to become 40 times? I'm not saying this is so easy. It will take time. It is not going to happen next year or next to next year. It may be taking 10 years. It may be taking 11 years. But it's okay if our money is going to get 40 times and our 3% invested today will remain invested for next 10 years and will be giving us 30% CAGR. It's too good. With our corporate life, if we can invest our money in 2-3 stocks like this, and we don't need to find new stocks, and this is what we are looking for from me, that Vivek bhai, we could manage both the things, means our active income as well as the earning from stock market. Right? And if we see the price performance of Britannia in the past, so let's have the weekly chart and see what has happened in last 20 years from 2002 till now. It has been 73 times. Britannia in last 20 years has been 73 times, 7,376% gain. And during this period, it has gone up, came down, gone up, came down, remained in the same range, then went up, then came down again. Means everything has happened. And right now, Mrs. Bector Food is not at lifetime high. That is also good part. Means I'm not considering it at a lifetime high. It has come down. Whereas the results are good. They are posting highest ever numbers, 279 crore rupees of revenue, highest ever. And this small difference in the net profit is due to margin pressure. That can happen with any company in a shorter period of time because of inflation. Are you getting my point? So this is how we need to understand. It's very simple, very simple. For example, one more thing, Punjab National Bank. What is the market capitalization? 46,000 crore. Another company, Kotak Mahindra Bank. 3,77,000 crore. So Punjab National Bank, Kotak Mahindra Bank is almost 8 times of the size of Punjab National Bank. Kotak Mahindra Bank is 8 times bigger in terms of market valuation. But in terms of business potential, see, how do they do business? Their own money and borrowed money. The larger is better because that is the inventory for them. That is the... So Kotak Mahindra Bank balance sheet has 1,400 crore, 1,492 crore plus 95,000 crore rupees, means their own money. I will explain you how to calculate this and everything, but their own money is 96,000 crore and borrowed money is 3,65,000 crore, means total capital is, total business potential is of this much of money. They have this much of capital basically to do business. 365,000 plus 95,000, almost 4.5 lakh rupees, whereas Punjab National Bank has 13 lakh crore rupees to do the business, and Kotak Mahindra Bank has 4.5 lakh rupees, whereas Kotak Mahindra Bank market valuation is almost 8 times. This kind of weird difference between valuation will not survive in the market. These are not going to survive in the market. Right now, the difference is because of the profitability. And why profitability was hampered? Because of the scams. But in last 7 years, none of the fresh loan has become NPA. Do you know that? In last 7 years, none of the fresh big size loan has become NPA. All are older. All are prior to 2014. All are prior to 2014. Right now, this is just a cleansing process that is happening, that is going on. And once this NPA part will be over, these government banks will be giving us the same profitability on the available capital. A lot of people argue or put their point that Vivek bhai, can we expect the same performance from government employees having the same attitude, having the same aptitude, having the same behavior? The time will change going forward, and time has changed in the recent past as well. Right now, I also have these Sarkari bank account, but I don't need to go to the bank at all. There's no need. Bank of Baroda mobile application is working perfectly fine as HDFC Bank mobile application is working. I don't need to go to the Sarkari bank. Not at all. There's no need. So there's no difference of human behavior. There's no difference. I don't go to HDFC Bank. I don't go to ICICI Bank. So I don't go to my SBI and Bank of Baroda also. And in coming years, with the launch of e-rupee, all these things will be cleared again. Let me tell you one thing. Next 10 years will change India's face. We may be witnessing more than 15% growth rate, GDP growth rate, more than 15% we may be witnessing. Even we may be witnessing 20%. How? India is not a poor country, let me tell you. India has parallel economy, bigger than the normal economy. If we buy a flat or plot in Gurgaon, and if the cost of the plot is 2 crore rupees, then 1.5 crore rupees will go in cash. Only 50 lakh rupees will go from the check. Seller is not ready to sell with all cash deal. They want in black. So this 30% is with the check in Gurgaon, but in Delhi, 90% is in black. Only 10% is white. With the launch of e-rupee, the black economy will be a matter of history, past, within 10 years. It will change everything. Very soon, all of us will be getting a rebate from our corporate. If you want salary in rupee, in e-rupee, from the government side as well, if we are ready to get our salary in e-rupee, then income tax rate is 10% lower than the normal rate. In that case, what do we expect from all the employees? Paying 10% more income tax or paying less income tax? When all the employees will be getting e-rupee in their account as a compensation, they only have one option to spend the e-rupee only, which cannot be withdrawn from the ATM card, means from the ATM, in the hard cash. And everything will change immediately. Everything will change. This time government is not making a noise. They are just working. Because they had made enough noise at the time of demonetization and they had failed. Because they could not understand that our banking system is such a corrupt system. They could not understand. There was a political motive also behind that. I understand. But the main motto means the entire decision was failed because of one thing, because of the corrupt banking system. So this time they are not making a noise. They are just working on it. Just working on it. For example, when government had announced that every citizen need to link their Aadhaar card with the bank account. Every opposition party was opposing this move. Right? They were opposing this move. But what happened? This political party, means the current government, just stopped saying anything. However, instructed all the bankers that you will not open any bank account without the Aadhaar card. So the same thing is happening right now also, but without saying anything. Are you getting my point? We are going to have the best 20 years any country had in the past, in any time. We will not see any recession in next 20 years. And the whole world will be looking at India only. They will not have any other opportunity. They don't have any other option. So whenever you hear something like FIIs are selling or DIIs are buying or they are selling or this is happening in that country, that is happening in that country, just ignore. We just need to ignore. Let me tell you one thing. I had placed 2 times just one product's order on Amazon, air purifier of Dyson. And both the times that has been cancelled because of the non-availability. First, they took the order and after that, they cancelled. If you try to buy a car now, that will be delivered after 6 months, 7 months. And we are saying that we don't have money. So we need to have a look at the real numbers, not the rumors that there is a unemployment, youth is not working, we don't have enough jobs. We have everything. We have everything. We don't need to be emotional when we are trading in the market. Otherwise, we won't be able to make money. We need to have a look at the numbers, actual numbers. We need to have a habit. And to create a habit, just read one book, The Factfulness. This is a very good book. We all should read this. Factfulness. Okay, so market capitalization will tell us that this size of the company can grow 10 times, 20 times, 30 times, 40 times, 50 times. For example, one more thing, 5 paisa. What is the size of 5 paisa? 5 paisa market capitalization is 981 crore, right? And second company I'm opening is Angel Broking. And the market capitalization is 13,000 crore. So 981 and on the another side, Angel 1 is 13,000 crore. There is a gap of 13 times, more than 13 times, right? More than 13 times. Going forward with the growth in this industry, right now there are almost 2 crore active participants in the market. 2 crore. It means less than 2%. Less than 2% of the population. In America, this percentage is 65%. In America, this percentage is 65%. Means going forward, if we see the same percentage after 30 years, after 40 years, I do understand that it is not going to take 30, 40 years. It will happen in 20 years itself. However, we can see the massive growth. So what I mean to say, when Angel Broking is worth 13,000 crore rupees market capitalization, when only 2% people are trading in the market, going forward, when there will be more participants and 10% people will be trading in the market, so this 5 paisa will be at least of the same size that is of Angel Broking is today. Angel Broking will be growing much more further. Means Angel Broking market capitalization might be 50,000 crore, it could be 60,000 crore, but at least 5 paisa will be having the size that is of Angel Broking today. It means 5 paisa has a potential to grow 13, 14 times. And if I say that it is going to take 5 years, then I am okay if my money will be 13 times in 5 years. I am okay. And the best part is, this industry has already seen the price war. That is the best part. There is no more price war. Nobody is going to reduce per trade 20 rupees charges. As such, there is no price war. It has already happened. They are the discount broker. And everyone is going to have more than one trading account. That is also beauty. For example, in my personal name, I have 7 demat accounts. In my personal name, I'm saying, total family have more than 14, 15 accounts. For example, when we grow up, we don't have single bank account. We have multiple bank accounts. In the same manner, we will be having multiple demat accounts. In the same manner. So even though someone is trading in Zerodha, would be having a demat account with Angel One and as well as with 5 paisa. Are you getting my point? Right now, a lot of people think that how this Zerodha is making money. Zerodha is charging almost 300 rupees annual maintenance fees for doing nothing. 300 rupees. And they have almost 2 crore demat accounts. So this is 600 crore rupees they are getting every year for doing nothing. And people do question that how Zerodha is making money. So we need to have a look at the numbers. We need to become a baniya. We need to become a businessman when we are crunching the numbers. There is no accounting. So this is how we need to have a look at this small company and the next competitor and compare what is the opportunity. This is so simple. One more example. Indigo Paints. Indigo Paints is the fifth largest paint company and 4th largest decorative paint company in India, having a market capitalization of 7,338 crore. And the largest company in this field is Asian Paint, 3 lakh crore. So 3 lakh crore divided by 7,500 crore, it means 40 times. So the Asian Paint is 40 times than the Indigo Paints. And paint industry has a very low penetration. We can see paint everywhere. This is not only in the houses. This is in the school. This is on the road. This is on the trucks. This is on the pole. This is in the factories. All machineries. It's everywhere. Everywhere I'm saying. Right? This is on the car. This is everywhere. And with the increment in per capita income, people will be using more paint. They will be consuming more paint. Right now, Indians are getting their houses repaint only on some events, some occasions. But going forward, it is not going to happen in that way. In Singapore, there is a policy that every 3 years, every building will be repainted. Every 3 years, there is a policy. With the prosperity, this thing will come to India also. And means it will not be visible. It will be visible when we will see. But if we just generalize this, is there any difference? What has happened in last 10 years? Let me tell you one thing, what has happened in last 10 years. There is no man-pulled rickshaw on the road now. In any major city, there is no man-pulled rickshaw. There is no man-pulled rickshaw on the road now. It has vanished. And there was no mission for that. There was nothing from the government side. There was no advertisement. There was nothing. Just one thing happened. During these 10 years, per capita income has increased. And that's it. So the people, those who were buying hand-pulled rickshaws, they are able to buy now battery-driven EV rickshaws. And this is how these three-wheelers will be a history in next 15-20 years. People will not be traveling in three-wheelers. People will be traveling only in the taxis. And from smaller taxis to the long taxis like New York. Like the taxis in New York and Dubai and everywhere in the world. So what I mean to say, if we will try to look at the numbers, then we can get a lot of insight. It is very easy to see the insight when we are analyzing the numbers. But if we are just listening to the stories, if we are watching the TV, and if we are listening to the rumors, then nothing will happen. People and opposition parties will keep on cribbling. They will keep on shouting every time. We need to have a look at the numbers. Do we know in today's time 90% crop, farmers' crop, 90% crop are insured? Do we know that? 90% crop are insured today. And what was 10 years back? Nothing. I'm saying nothing. So India is changing. Numbers are changing. We have much more buying power. Otherwise, how can Toyota Innova means Toyota company can stop taking the orders itself, saying that we have such a long backlog to manufacture, we are not taking any fresh order. Toyota is not taking booking for the Innova. Fortuner has a waiting of 7 months, 8 months. Even forget these big cars, small cars have a long waiting. Right? Jeep Compass has a waiting of 12 months in petrol version. Otherwise, these companies were struggling to sell their products. So where this money is coming from if we are poor? We are not $3 trillion economy. Remember, we are $10 trillion economy. This is not because of semiconductors right now. It was the case of semiconductor, but today it is not the case of semiconductor. Their plants are running at the full capacity. Are you getting my point? Our economy is $10 trillion economy. The only difference is that this is running parallelly. And with the launch of e-rupee coming in force with a low tax rate, we will be growing much more faster, and that normal white economy, once we will have more money in banks, we will not have any other option but to invest in the stock market. Right now, people are investing again in real estate just because of one thing. Because they can infuse such a big amount that is available in cash only in real estate. If they will convert this cash in white, they will have to pay hefty tax. So this cycle is there and it will be broken very soon. Okay, so you got the importance of market capitalization. We spent almost 40 minutes on market capitalization itself. Why? Because it gives us idea that this small company having the same brand value as its competitor can grow in the same multiplication. And these companies have grown in the past. For example, we were talking about Asian Paints. See how Asian Paint has grown in the past 10, 20 years. From 2003 till now, Asian Paint has grown 99 times, 100 times. So if Asian Paint can grow 100 times, we can consider that Indigo Paints, having a good reputation in the market and having MS Dhoni as the brand ambassador, can also grow. Right? Now, next point. Next point, first is the market capitalization and second is the current price. Current price is per share and market capitalization is for the company. High-low is not having any relevance here. Stock PE. Stock PE is one thing that is confusing almost everyone. Those are doing financial analysis. That what is the right PE? PE means the price earning ratio. So first of all, the formula to calculate PE is P for price. Price means what? Market capitalization. And E means earning, means the net profit of the company. So let's not go with the per share price and per share earning. That is difficult to calculate. The easier way is price means the market capitalization, the price of the company, and earning means the net profit of the company. Because these two figures are easily available. Right? These two figures are easily available. So in case of Asian Paint, what is the price of the company is 3 lakh crore, 3,05,000 crore. And what is the net profit of the company of 1 year is 3,500 crore. What is the real meaning of PE? Real meaning is payback period. Please note it down. Payback period. P-A-Y, pay back. B-A-C-K, back period. Payback period. It means if we do get the same profit every year, then it is going to have 81 years. We will be getting the same cost in terms of profit in 81 years. It is going to take 81 years to give us our money back. For example, if I bought this company for 3,05,000 crore rupees and company is giving me 3,500 crore rupees of net profit every year and it doesn't change, then I will be recovering my money in 81 years. So this is the real meaning. Payback period is the real meaning of PE ratio. So 81 years. And in today's time, companies trading at 50 PE, 40 PE, and 50 PE, 60 PE is a normal thing. No, it means it is going to take 60 years to give my money back if I just bought the entire company, if I buy the entire company. But there's a catch. The catch is this net profit is not going to remain same. It is always increasing. It is always increasing. So if we do take an example here, HDFC Bank, right now it is trading at a PE of 20. Right? And right now the market capitalization is 8,34,000 crore rupees. So in the last 10 years, if we see from 2012, March 2012, almost, this stock price has gone up by 5.5 times, 5.5 times. There is a gain of 457%, means the price has gone up, means The price was 267. Now price is 1537. It is 5.5 times. It means the market capitalization was 834,000 divided by 5.5. The market capitalization was 1,50,000 crore rupees almost 10 years back. You got it? Very simple. The market capitalization was 1,50,000 crore rupees almost 10 years back. And that time, what was the net profit of this company? March 2012, the net profit was 5,200 crore rupees. It means the company was trading at a PE of almost 30. 1,50,000 crore was the market capitalization and 5,000 crore is the net profit. So the PE was 30. Market capitalization divided by net profit is equal to PE ratio. Means the 30 PE. However, if we do calculate 5,277 means how many years it does? 5277 plus 6903 plus 8768 plus 10703 plus 12821 plus 15317 plus 18561 plus 22446 plus 27296 plus 31857 plus की जरूरत ही नहीं है, there is no need. Means 1, 2, 3, 4, 5, 6, 7, 8. In just 8 years, company earned a net profit of 1,50,000 crore rupees. Whereas at the time of buying, the PE was 30. It was looking like that it is going to take 30 years to give us same profit as the cost. But because net profit is growing every year, it just took only 8 years. That's it. So that's why there are a lot of companies, those are trading at a PE of 100, those are trading at a PE of 120, 130, and still it's okay to buy at that PE because the every year growth rate in the net profit is very high. Right? And in the same manner, on the other side, there are a lot of companies, those are trading at a very low PE, at a PE of 6, 7, 8, 9, 10 maximum. And majority of cases, these are PSU companies. Those are having a very low PE. What is the reason? Because there is a very less profit growth rate every year. For example, if we see Coal India, the PE ratio is only 6.5. Only 6.5. And if we see the change in net profitability, there is no change during these 8-9 years. 17,000 crore net profit in March 2013 and same profit in March 2022. There was no change. That's why these companies are not commanding a high PE ratio. So what is in nutshell? Nutshell is, if the PE ratio is less, then this is good. But if the PE ratio is high, this is not bad. Right? If the PE ratio is low, this is good. If the PE ratio is high, this is not bad. And in taking any kind of financial decision or trading decision in stock market, from our point of view, this PE ratio is totally irrelevant. This is totally irrelevant. Totally irrelevant. It will be relevant only in one case. When we are trying to buy ultra cheap valued stocks. And we don't need to go for that. We are traders, we are not long-term investors. Remember. Asian Paint has never been trading at a low PE is still giving good returns because every year profitability is increasing. Right? For example, HDFC Bank 10 years back was trading at a PE of 30 and now trading at a PE of 20, but still giving us 457% gain. It has become cheaper in terms of PE valuation, but it still gave us 457% gain. So that's why PE ratio is not important at all. We just need to ignore it. Okay. Second is the book value. This book value. We need to understand the book value concept first. What is book value basically? So there are three things: book value, face value, and current market price. And these three concepts always confuse us. That what is this exactly? What is the importance of face value? What is the importance of book value? And what is the importance of current value? And why they are different? So we will be having a clarity on this for the rest of the life in just next 5 minutes. Okay. So there is an example. There is an example. Example is, suppose we have 100 crore rupees and we started a factory. Please listen to this carefully for 5 minutes and you will have a clarity about face value, book value, and current market price for the rest of the life. So if we have 100 crore rupees and we started a factory, we just set up a new company and we started a new factory with 100 crore rupees. So this 100 crore rupees will be share capital. So the initial investment of this 100 crore rupees will become share capital. Okay. Now, in 1 year, going forward, after 1 year, we earned 20 crore rupees as net profit. Right? We earned 20 crore rupees of net profit. So this net profit will be going to the reserve. It will become the part of the reserve, and the first 100 crore rupees will remain share capital in the balance sheet. So the initial first 100 crore rupees invested, not the 100 crore rupees, but whatever the amount is. It could be 10 crore rupees, it could be 20 crore rupees, it could be 1000 crore rupees, right? So the first initial investment will be called as the share capital. And after that, we made 20 crore rupees on this. This 20 crore rupees will become the reserve, right? And the total of these two, share capital plus reserve, will be called as the book value. So what is the book value? Please note it down. Face value is equal to share capital is equal to initial investment. So these three things are the same. Face value, initial investment, and share capital. All these three things are the same. There is no difference. Initial investment is called the share capital of the whole company. And when we do divide this share capital by the total number of shares, then it becomes the face value per share. Means the formula of share capital is total number of shares multiplied by face value. For more clarity, you can note it down. Share capital is equal to total number of shares multiplied by face value. So in this case of 100 crore rupees of initial capital, we can say that we had 100 crore shares. and the face value was 1 rupee. Okay. We had 100 crore shares with face value 1 rupee. So face value is 1 rupee. Share capital is 100 crore. So face value for the whole company is 100 crore. Per share is 1 rupee. You got it? You got the clarity? So initial capital is called the face value, and this is called the share capital as well. Okay. And after that, during the period, we made 20 crore rupees. After that, in the next year, we made 30 crore rupees of net profit. After that, we made 50 crore rupees of net profit. And say, for example, after 10 years, means during these 10 years, the company made 300 crore rupees of net profit, for example. So this 300 crore rupees will become the part of reserve. Right? Whatever profit we are making after tax is going to become the part of reserve. So for example, if we see MRF, what was the initial capital? Initial capital was only 4 crore rupees. Just 4 crore rupees was the initial capital. And they have made 14,000 crore rupees of net profit after tax so far. After tax, after dividend. After tax, after dividend means whatever has been retained within the company that has not been distributed. And the initial capital was 4 crore. Why I have taken this example? Because MRF has never split the share price and they have never distributed the bonus share as well. That's why. So share capital plus reserve. Share capital plus reserve is equal to book value. Share capital plus reserve is the book value. So share capital is the face value. Share capital is the face value. Share capital plus reserve is the book value. And this book value is also called as the equity. Equity is not the share capital. Equity is the share capital plus reserve. Means companies own money, shareholders own money, apna paisa. So two concepts are clear now. The difference between face value and book value. So what is equity? Equity means companies own money. The initial investment plus retained profit, both. Share capital plus reserve, both. So this book value can be seen in two ways. As the whole for the company or per share. So book value for the company is share capital plus reserve. And if we divide this by the total number of shares, it will become book value per share. Right? For example, we are taking the same example here. The total book value for the company is 4 crore plus 14,028 crore. 14,028 crore plus 4 means 14,032 crore. If we divide this by the total number of shares, where is the total number of shares? Total number of shares are 42 lakh because these numbers are in crore. 0.42 means 0.42 crore means 42 lakh. So 14,000 crore divided by 42 lakh means the book value is 33,000. So book value means per share. Equity means for the whole company. We can see all these figures in two ways, in two forms. One for the company, one per share. Face value generally when we do talk about is in terms of per share. Face value whenever is considered is per share. But for the whole company, this is called the share capital. Face value is per share. But for the whole company, same thing is share capital. Book value is book value is per share. But when we are considering it for the whole company, it becomes the equity. Means the share capital plus reserve. Okay. Now, for example, when we are taking the same example here, the company was set up with the initial investment of 100 crore rupees. And later on, the company made this company was set up with 4 crore rupees, and the company made 14,000 crore rupees as the reserve. So the market price should also be same 14,000 crore or much more higher than that. It must be higher than that. Why? Because land prices remain same in the balance sheet. Land prices does never get revalued. Never. Land prices will remain same. It means with the 4 crore rupees total investment initially, there must have been some land where the factory was set up. In 4 crore rupees in Gurgaon, you cannot buy a plot. And they have a land for the factory. So what would be the price of that land today? So that price is not reflected in reserve. You got it? This reserve is something different, something earned later on. For example, Mavana Sugar. The whole company is coming in 317 crore. The whole company is coming in 317 crore. And in balance sheet, we can see the book value is 39 plus 345. That is the equity. It means almost 400 crore rupees. If we go to the fixed assets and we drill down, the land value is 19 crore rupees. Mavana Sugar land value is 19 crore rupees. Right? Mavana Sugar land value is 19 crore rupees. They have 2 sugar mills. And Mavana Sugar Mill itself is 1 kilometer wide and 4 kilometers long. Almost 800 acres. And the actual price in that location of land with such a large piece of single land would be at least 5 crore rupees per acre. So the land price is 4,000 crore rupees. The market price of that land is 4,000 crore rupees, but in the books, it is only 19 crore rupees. Why? It might have been bought with 19 crore rupees in 40, 50 years back. You're getting the point? So this book value speaks a lot. We just need to go much more deeper. If this is a factory and land value is a smaller one, and we know that they have very large factories, it means the real worth of the company is much more higher than that. And that's why all these sugar mills are still running in losses, and still promoters, owners of the company are running that, because they know when they will be selling it, they will be getting much more worth. And that's why there is a entry restriction, entry barrier in this industry. That's why there is an entry barrier in this industry. Because if someone would be coming as for a fresh factory, means for setting up an ethanol plant, this ethanol plant can only be set up in a fertile land near to the sugar cane. And that land is a costlier land. Right? And they will be spending thousands of crore rupees only to acquire land. And they cannot compete with the existing players. We can have all the questions with you. We will be coming with the question answer, but let's finish first. So in this case,
So just relevant to this, Vivek, sorry to interrupt you.
Yes, please.
Makwana land initially was 26 crores, which has gone down to 19. What would have been?
So in that case, sometimes what happens, they must have sold a small piece of land because as I told you, they have 2 factories and they must be having other land as well. That's why.
But that could have got reflected in their profit. Because obviously they would have actually sold it at much higher price.
We understand that these promoters will not be bringing this profit in the company. Why would they? They would be showing that as if they have sold it for a very small amount, and they will be taking every profit in their own means in their own accounts. This is the irony.
So the same way that 19 actually should not matter to us. It will remain 19 for us in any case because they will never reflect.
But it will give us a buffer means buffer when we are considering whether new players can enter this industry or not.
Oh, understood.
Right. The same thing we have seen in paper industry in last 7-8 years. These paper companies are making good money consistently. They are increasing profit because new players cannot enter.
Yep.
New players need to have their own jungle, a large land size. Existing players do have that. New players will be spending crores of rupees just to acquire land. And that's why there is an entry barrier. And paper demand is increasing every year. Whatever we are buying today is coming in a paper pack. All restaurants are using paper like anything. All restaurants. All pizzas are in paper. All burgers are in paper. Even Haldiram is using paper on the tray itself. And for nothing. We are using tissue papers like anything. And there is an entry barrier. And the same thing is going to happen in sugar mills also. Ethanol will be in high demand. And there will be entry barrier. And all these companies will be making good money. Right? So if the book value is higher than the share price, if the book value is higher than the share price, then this is good. But if the share price is less than the book value, this is not bad. You can note it down as it is, not for yourself, but for your kids. If the book value is higher than the price, this is good. It means the stock price is trading below the actual worth. But if the share price is less than the book value, sorry, higher than the book value, if the share price is higher than the book value, then this is not bad. It's okay. For example, if we take an example of Dabur, what is the book value of Dabur? The book value of Dabur is 8600 plus 177 means almost 9,000 crore. Almost 9,000 crore. Right? And the market capitalization is 98,000 crore. Means the market price of the company is 10 times higher than the book value. Right? Why? Because of the brand value. Because of the brand value of the products itself. Dabur has so many products, those are 100-year-old products, 100-year-old brands, basically. If I give you an example, Hindustan Unilever had bought Horlicks for almost 20,000 plus crore rupees. Hindustan Unilever bought Horlicks 3,045 crore rupees was the cash, and otherwise it was almost 40,000 crore rupees, the total deal that they had paid in terms of number of shares. This is not written here, but this was in the balance sheet itself. If we go to Hindustan Unilever, and if we go to the balance sheet, you see the reserve was 8,000 crore rupees earlier, and later on it was 47,000 crore rupees, because 40,000 crore rupees were infused just to buy Horlicks. 40,000 crore rupees were infused just to buy Horlicks, one brand. Are you getting my point? And before this, the whole book value of Hindustan Unilever was just 8,000 crore rupees, because all other brands were homegrown brands. You got it? Each and every brand is worth much more than that if they sell it. If Dabur try to sell Dabur Chyawanprash, might be he would be able to sell it at 20,000 crore rupees. Just one brand. Might be. So that's why if these companies are trading far above the book value, this is absolutely fine. Because brand value is not the part of book value. This we need to consider extra. And this brand value has been created by the company in last many decades. Got it? So book value is important. If the share price is trading below book value, then this is good. But if the share price is trading above the book value, then this is normal. It doesn't make any difference. It doesn't make any difference. Now, next point. Return on capital employed. But before that, dividend yield. Dividend yield, again, is not important at all. Few companies are paying dividend much more than other companies. So companies, those are paying more dividend, it means the company is not able to utilize the earned profit to make more profit. The company is unable to expand the business with this earned profit. And that's why this Coal India is distributing profit every year. The dividend yield of Coal India is 6.91%, almost 10%. Right? So more dividend doesn't mean more profit. This stock price has not done anything in last 10 years. We had seen this. The stock price was listed at 348 almost 12 years back and now trading at 246. Even if they are paying dividend, it has not given us any profit at all as such. So a lot of people says that Vivek bhai, REC Limited and PFC are paying 10% dividend. Is it good to buy? We should never buy any stock just for the sake of dividend. If we are really interested in dividend, then fixed deposit is a better option with the safety of principal amount. Right? So dividend yield is not important at all. We just need to ignore this. Next point is return on capital employed. return on capital employed is one of the most important factor to ascertain, to measure product's credibility in the market as well as management's capability. It shows that how much money is made on the available capital. How much money is made on the available capital. None of the management, even if the management is a superb management, can make money if the product is not good. For example, Bharti Airtel. Excellent management. But still, that company is not able to make enough profit. And the balance sheet is a debt-ridden balance sheet. They have a lot of debt in the balance sheet. Right? So we need to have a good product. For example, Vodafone Idea. The same Kumar Mangalam Birla who is running Ultratech Cement is unable to bring Vodafone Idea a profitable venture because the product is not a good product anymore. Even though this is being used everyone, but because of high competition, they cannot increase the price. The reason is there is no brand value. There is no brand value. Vivek bhai, are you serious? There is no brand value in Bharti Airtel in comparison of Jio? If Jio will be giving us, or Jio will be charging 500 rupees per month, and on the other hand, Bharti Airtel starts charging 700 rupees a month, will we not be shifting to Jio? Where's the brand then? Are you getting my point? Brand is in the handset, not in the network. Brand is in the handset, not in the network. And because brand is in the handset, that's why Apple is able to sell its product at 1,50,000 rupees a piece. And they had started selling at 30,000 rupees a piece in 2003 in India itself. Right? So we need to be careful when we are thinking about the brand value. We need to see the pricing power. If with the rising cost, the company has been able to increase the prices of the product or not. Right? So return on capital employed is important. Now, that's why if a company is posting less than 15% ROCE, then we are not trading in that company. If you see as a condition, as a rule to identify a list of V200 companies, we have a rule that the return on capital employed should be more than, what is the percentage? 20%. Right? That's why. And there is an exception. Exception is the banking and NBFC companies, financial companies. That is the exception. So whenever I'm making a video on YouTube, considering a stock to go up, and that stock is having less than 20% ROCE, you simply need to ignore that. Right? I'm on YouTube to discuss a lot of stocks because of a lot of reasons. And these reasons are, in most of the cases, to teach them that how to analyze a business, how to analyze a financial, how to analyze the technicals. And those stocks might be in the portfolio of a lot of people so that they can take a call. It doesn't mean that you need to buy. You need to learn when I'm discussing anything on YouTube. But it's okay if you have bought in the past a lot of stocks based on that, it's absolutely fine. Nothing is wrong. I'm not saying that I'm discussing wrong stocks. What I'm saying is, after taking the classes, you need to stick to the rules. Those are being taught in the class itself. This is what I mean. We don't need to get confused. Right? So return on capital employed, if this is higher than 30%, you can note it down again. If this is higher than 30%, then this is best. Return on capital employed, if this is higher than 30%, then this is best. If this is more than 20%, this is very good. Return on capital employed, if more than 30%, this is best. If this is more than 20%, this is very good. And we will not be going below very good. Right? We will not be going below very good. This is for the understanding actually. There are very few companies in the world. Please listen. There are very few companies in the world, those are able to generate consistently more than 30% ROCE. Very few companies in the world. I'm not talking about India only. I'm saying in the world itself. So this is a very simple formula. Just a single formula can filter out all good companies in any stock market in the world. If we are moving to Canada and we are trying to trade in Canadian market, then simple formula to filter out good stocks list is to see if the company is making 30% ROCE or not. 30% ROCE is not everyone's capability. This is beyond capabilities. Extremely great products or services and extremely integrated management. Right? So we need to be careful, and we will try to trade only in the companies posting more than 30% ROCE. But if there is no opportunity in more than 30% ROCE, then second preference could be given to more than 20% ROCE. But if we have opportunity in 3 stocks, and out of these 3 stocks, one stock is giving more than 30% ROCE, then preference should be given to more than 30% ROCE generating stock. Right? Next is ROE. ROE is not relevant. We will be ignoring this. This is relevant only in case of banking and financial institutions, where we have chosen that it should be more than 10% or 12%? 10%. Yeah. Next is face value. We have understood this. The concept of face value is clear. Basically, face value is nothing but the initial investment. Face value is nothing but the initial investment, which is called the share capital. And book value is the share capital plus reserve. We call this equity as well. And the current market price is the current value, which is called the market capitalization. Right? Now, the next important point is debt equity ratio. Debt equity ratio, which should not be more than 25%. So if debt equity ratio, please note it down, if debt equity ratio is less than 10%, if debt equity ratio is less than 10%, then this is best. %, we can call it 0.10% as well. Right? 0.10 or 10%, both are same things. So if debt equity ratio is up to 10%, means less than 10% or up to 10%, then this is best. And if this is more than 10% but below 25%, then this is very good. and 25% is Lakshman Rekha for us. 25% is Lakshman Rekha. We should not cross that. Stock selection is more important than technical analysis. If we are making a mistake in buying at a wrong price, but if the company is good, it will be okay in future. But if we are buying at a right price and the company is not good, it might not be okay in future. So company selection, stock selection with the help of business analysis is much more important than stock price, means the technical analysis. Never compromise on the stock's quality. I might be discussing a lot of stocks on YouTube. Those are not of that quality, but I do understand that those stocks are available that time, at the time of making the video, available at a ultra low valuation that is bound to bounce back. That's why. Right? Vignesh bhai, we will talk later on this. Okay. Now, so what does it mean by equity here? What is the formula? Formula is debt divided by equity. And that means what? That means borrowing in the balance sheet. The borrowing in the balance sheet means debt. And equity means share capital plus reserve. That means borrowing. That means borrowing. And equity means share capital plus reserve. Next point. Promoters holding. We have a lot of confusion in that. But I think in the first session itself, I had given some clarity. A lot of people says the more promoters holding is better and less promoter holding is bad. A lot of people says. So if we are talking about it, in banking and NBFC, debt equity ratio is not important. Not at all. Please note it down. In banking and NBFC, debt equity ratio is not important at all. There are a lot of companies, those are not directly NBFC or banking, but still in the business of lending. For example, stockbrokers. For example, stockbrokers. Stockbrokers are not directly in the business of giving loan, but they are providing the funding facility and they are charging interest on that. So if we do see more than 20%, 25%, 30%, 40% debt equity ratio, then this is fine in those companies. Because these companies are indirectly NBFC companies. Even much more safer. Right? We need to make sure. Now, promoters holding. So in case of Dabur, is a great company and promoter holding is 67%, and another company we are taking Kotak Mahindra Bank and the promoter holding is 26%. Another company we are taking ICICI Bank and promoter holding is 0. And we are taking TCS, the promoter holding is 72%. However, in case of HCL, the promoter holding is 60%. And in case of Infosys, the promoter holding is only 15%. So Infosys having promoter holding 15%, TCS having in promoter holding 72%, and both are equally good companies. Kotak Mahindra Bank having promoters holding 26% and ICICI Bank 0%, and both are equally good banks. Actually, promoter holding is not important. It doesn't make any difference. Difference is being created by the strong hands versus weak hands. Please note it down. Shareholding should be analyzed in terms of strong hands and weak hands. So what are the types of shareholding? Number one, promoters. Please note it down. Promoters. Number two, institutions. Institutions are having subcategory FIIs and DIIs. And third is public. Public are also having two categories, HNI and retail public. We had discussed this in the first day, right? So there are three categories: promoters, institutions, and public. Promoters are promoters. Second is the FIIs and DIIs, means institutions. And third is the public, that is HNIs, and the retail public. Here, the strong hands means promoters plus FIIs plus DIIs plus HNIs. These are the strong hands. And the weak hands are only retail public. And out of these retail public, 97% people are losing money, only 3% are making money. And academically, these 3% people are not from top colleges. And 97% people, those are losing big money, are having people, I don't need to say. Means what? Stock market has nothing to do with our academic background. It has to do everything with the understanding of common business, human behavior, understanding of the cycle, understanding of the nature. Right? Why I'm telling you this thing? Because I'm telling you everything that is practical in nature. We need to understand so that we don't commit this mistake that I have this degree, so I will be making more money. It's not like this. If we are much more humble, if we are much more blessed, and if we are much more patient, then we will be making much more money. And moreover, if we are much more disciplined in following all these strategies as it is, then we will be making much more money. Right? So these weak hands are comprising both the groups, the group that is making money and the group that is losing money, because I am also the part of this weak hands only. I'm a retail investor. I'm not HNI. Right? I don't have more than 1% in any company. And I don't want to have also. I don't want to come in limelight. There's no need. Why there is no need? Because we are here to make money. We are not here to become a hero. There is no need. We must have a lot of money and nobody should come to know about it, so that we can live happily without having bodyguards. Again, why I'm telling you this? Because I know once you will start practicing these learnings and applying these learnings, going forward, you will be making handsome money. There is no doubt about it. All these strategies are well-proven strategies. And the strategy that we will be learning tomorrow, you will be saying, Vivek bhai, pehle wali kyun sikhai thi? Right? But that's okay. We need to learn more number of strategies so that if we don't find a stock based on one strategy, we could find a stock based on another strategy. We could trade in the market. That's why. And someone is comfortable with one strategy and another one is comfortable with another strategy, because we are different human beings. Okay. So the promoter's holding is not important at all. What is important is the strong hands and weak hands. For example, Axis Bank. What is the percentage with strong hands? The percentage with strong hands is more than 7%, because 12% with retail public and 1.85 plus 1.33 plus 1.06 is with the HNIs. Means with the weak hands, retail public is only 7 to 8%. That's it. Public is having 12%. Retail public has only 7 to 8%. And in case of HDFC Bank, the retail public has 14%. Weak hands are having 14%. But in case of Axis Bank, retail public has only 8%. Time has changed now. A lot of people would be saying time and again, Vivek bhai, how can you compare Axis Bank with the HDFC Bank? Now I can compare. I can see the numbers. Are you getting my point? I can see the numbers. I can see the improved numbers. I can see what big guys are doing. So always try to consider the numbers. You see what FIIs are doing. FIIs have sold almost 5%, almost 6% from HDFC Bank during last 3 years. Whereas during the same time, FIIs have bought. Not bought, they have sold only 2% from Axis Bank. And in case of ICICI Bank, FIIs have sold just 1%. That's it. So weak hands versus strong hands, that is only important. Promoters holding are not important. Now, pledging percentage. We have a lot of confusion about it. Pledging percentage. Why TCS is having a pledging percentage? What do we mean by pledging percentage? Pledging percentage means promoters have this much of percentage of shares pledged with the banks. to take a loan. So when I'm saying promoters, not all shareholders, this pledging percentage is belonging to promoters shareholding only. Please note it down. Pledging percentage means promoter shares pledging, not everyone's. And this pledging is being done by the promoters, not by the company. This is the second line. We need to note it down. Pledging percentage is of promoters, not all shareholders. This percentage is belonging to promoter shareholding only. Pledging percentage, not all shares of the company.
Sir, just a quick doubt regarding this only. Sir, for example, if I have a company and I am 30% holder, I'm a promoter of that company. And for example, I pledge a small amount of it
Say,
to,
for example, 1% of your holding.
yes, 1% of my holding.
Then this is 1% of promoters holding. This is not 1%
30%.
of the company.
That means 3.33% will be reflected on the pledging percentage.
No,
Now,
no,
okay,
1% will be reflected.
okay. Oh, I have another question. So this loan taken is usually usually used for the company running the company, or it's personal for me?
No. I'm explaining you. The second line you need to note down is pledging is being done by the promoters, not by the company. So promoters are taking this loan in the personal capacity. Company is not taking loan by pledging the percentage because company does not have any share. Share is being held by the shareholders. Right? Shares are being held by the shareholders. Shares are not being held by the company. So in this case, TCS, what is the percentage? 0.48%. Now when TCS is having a loan, a small loan of 7,460 crore, and on the another side, company has cash also, and company has investment also, 43,000 crore rupees of investment. Why TCS will take a loan and why TCS will pledge the shares? Whenever a company is taking a loan, then company shares are not being pledged. Company's assets are being pledged to take a loan, not the shares. Remember, company's assets are being pledged, not the shares. So in this case, I do remember Tata Sons had bought shares of Tata Motors from the open market 2-3 years back. Tata Sons had bought shares of Tata Motors. Tata Sons is the owner of the group, right? So Tata Sons had bought shares of Tata Motors from the open market, from the public. And that time, Tata Sons had pledged few shares of its own with the bankers to take a loan to buy shares of Tata Motors. Tata Sons had taken the loan from the banks with the pledging of TCS shares to buy Tata Motors shares from the market. For example, I had not made a video on this, but let me tell you here, Vedanta Limited, 100% shares are pledged. Why? Because the promoters wanted to delist the company almost 3-4 years back, and they failed. They wanted to delist because the share price was trading at a dirt cheap price. very low price. And they wanted to buy at that price, low level, and delist it, and to relist it after a few years at a very high price. But they failed because they could not buy a certain percentage from the market, because they didn't have that much of money. But they wanted to have control on the company itself. So they did something different game. They played a different game. See, if we go to the shareholding was 50% of promoters, and now this is 69%. So what they did, and they are increasing their holding. See, Twin Star Holding is increasing the holding, right? They are increasing. And this Vedanta Holding Mauritius Limited from 0% to 5%, then 5.6, then 13.26, means the promoters are buying. How? They pledged their own holding with the bank, took the loan, and with that loan amount started buying shares from the market of own company and increased the holding from 50% to 70%. And now, to repay that loan, what they are doing? They are distributing the dividend, right? And what is the percentage of dividend? 15%. 15% dividend. And what is this amount in absolute terms? If we see dividend paid, 19,000 crore rupees of dividend was paid in March 2022 year, 19,000 crore rupees. And because out of 19,000 crore rupees, 70% shareholding is with the owners now, promoters now, means 19,000 multiplied by 70% would be going to them, right? And when this much of money would be going to them, they will be repaying loan and unplacing their shares. It means what happened? They bought or they got from 50% shareholding to 70% shareholding without putting even a single rupee from their own pocket. Took the loan from the market by placing their own shares, right? And then increasing they increased the dividend, they repaid the dividend, and they repaid the loan. They might be repaying the loan, and for the time being, it might be possible they would be increasing the shareholding from 70% to maximum limit, that is 75%. Who knows about it? Are you getting my point? So this pledging is being done by the promoters only. This is not being done by the company. So why this pledging percentage is bad? This is bad because of one thing. When promoters are taking a loan for any purpose, and here now the purpose could be to set up the semiconductor factory as well. And because of that, they might not be unplacing the shares. They might be using this high dividend income to set up the semiconductor factory. Right? Now, if this semiconductor factory does not succeed, or this business does not succeed, then what? Then these bankers will not be able to collect that loan amount from these owners, from these people. And in that case, bankers would be selling these pledged shares in the market to collect their money. And when this much of percentage of shares will be sold in the market, then there will be flood and the stock price will collapse. It will crash. And the same happened in case of Zee Entertainment Limited, Zeal. Otherwise, Zeal was a good company. This is a good company. And the debt on the Zeal Limited as a company was not a high debt. But still the share price collapsed. Why? Because the owner, Subhash Chandra, was not able to repay the loan taken from the bank with the pledging of these shares. and banks started selling these shares in the market. What happened to Reliance Communication? What happened to Reliance Power? What happened to Reliance Capital? What happened to Reliance Infra? The same story. Anil Ambani was taking loan by pledging one company's share to setting up another company. And there was a delay in execution in Reliance Power. And because of this, they could not pay loan of Reliance Communication. They could not expand the business there, and everything collapsed. So what is the conclusion? Conclusion is, if promoters holding multiply by pledging percentage is more than 10%, please note it down, this formula. If promoters holding multiply by pledging percentage is equal to more than 10%, then we should avoid that stock. Right? It means what? If the company's total number of shares multiply by 10%, you got it? If the 10% shares of the whole company are pledged, it means this. If the 10% of the total company shares are pledged, then we should avoid that company. Because this is our own money, we should not take any risk. And there is no need to take any risk. Never compromise in selection of a company. Never. There's no need. Because we are not managing people's money, we are managing our own money. And there is 1 account, 2 account, 3 account, 4 accounts maximum. And in our portfolio, we don't need to have more than 33 stocks. While selecting 33 stocks, then we can stick to the best of the best companies. There's no need for the mediocre companies. Same formula we can have in case of shareholding pattern, means more than 30% should not be with the retail public. More than 30% shareholding should not be with the retail public. I'm not saying here public, I'm saying the retail public. Public minus HNIs. Public minus HNIs. And HNI means people, those are having more than 1% in that company. Got it? Because we should not have, it means there should not be any reason why more than 30% is with the weak hands. Why strong hands are not coming to capture more than 70%? Why are they doubting on this company? So these are small filters we can use to find a better company. Right? For example, Karnataka Bank. Retail public has more than 70%. Retail public has more than 70%. And that's why this is trading half of its book value. Otherwise, this is also a private sector bank. Because majority of people, those are strong, are not in the board. Or they don't have a strong voice. But if 45% are with the FIIs, they have a strong voice. They can speak up. They can talk to the board. Please do something. But retail public cannot talk to the board. So if the 70% is with the strong hands, it means these strong shareholders will be talking to the board of directors in case if something wrong happens or if the profitability doesn't come. That's why. Right? Now, here almost all financial ratios are done and we are moving to the quarterly results now. So quarterly results, we will be seeing sometimes here view consolidated and sometimes view standalone and sometimes there is nothing. So what is the difference between consolidated and standalone? So wherever we have consolidated results available, we must see, we must check and analyze consolidated results only. Consolidated means the company itself and the subsidiary companies also. Subsidiary companies means the companies whose ownership is with the company. For example, I have a private limited company, V Spartans Consultants. And going forward, this V Spartan Consultants buy another company. So that another company is the subsidiary company of V Spartans Consultants. And while analyzing results, of course, V Spartan Consultants and the bought out companies, both these results should be considered on consolidated basis. Right? For example, Tata Motors was the Indian company, but Tata Motors bought Jaguar and Land Rover as well. So now today, while analyzing Tata Motors shares and its balance sheet and P&L statement, we should have a look at Tata Motors as well as the numbers of JLR. So combined together, all the numbers is called the consolidated. But sometimes a company doesn't have any other company. So there is no option to have a look at the consolidated and standalone. That is only standalone. But wherever both the numbers are available, we must consider the consolidated numbers. Right? Now, when it's here view consolidated, it means the current numbers are standalone numbers. And when we will be clicking here, view consolidated, now these numbers are consolidated numbers when view standalone is written here. These are consolidated. If we want to view the standalone, we need to click here. Otherwise, these are standalone. Don't get confused. When their view consolidated is written, it means these are standalone numbers. And when here view standalone is written, these are consolidated numbers. Right? So every time we will be checking consolidated numbers. After that, in quarterly results, the most important part is to compare current quarter with the same quarter of last year. Please note it down. Quarterly revenue and quarterly net profit should be compared with the same quarter of last year. With the same quarter of last year. It should not be compared with the previous quarter. September quarter results should not be compared with the June quarter results, or June quarter results should not be compared with the March quarter results. September quarter results should be compared with the last year September quarter. June quarter results should be compared with the last year June quarter, and March quarter with the last year March quarter. Why? Because all the businesses are somehow seasonal business. Asian Paint would be selling more paint in September quarter. In comparison of March quarter. Titan would be selling much more in December and September quarter because of the marriage season, because of the festive season, in comparing to the March quarter. That's why. Now sales, after that expenses, and this sales and this expense is directly relating to the main business. So revenue will be mentioned here. First, sales, and second, other income. So the main business related income will be shown in sales, and the income that is consistent but not directly relating to the main business will be shown in the other income. So what will be coming in other income? For example, company has fixed deposit with the bank and we are getting interest. Suppose we have investment in other companies and we got dividend. Suppose we have two buildings and one building we are using ourselves and another building we have given on lease, on rent, and we are getting consistent rent. But because rental income is not the main income, this is not the main nature. That's why even though this is consistent, even though we will be getting it every quarter, but we will be showing it in the other income because this is not the main nature of business. Right? So while analyzing numbers in other income, we need to make sure that this other income is almost consistent and there is no abnormality. Abnormality, like we can see that in last 2 quarters there was a other income of almost 3,000 crore rupees, but in March 2020 quarter, rather than to see 3,000 crore rupees of other income, there was a negative 386 crore. And on the next quarter then, there was 9,676 crore rupees of this. This is also abnormal because otherwise this is 3,000, 3,400 or 4,000 crore rupees. And this is 9,600. So what would have happened? The figure of this quarter is shown in June quarter. Right? The total of these quarters, now this is almost normal. Again, we can see here in December quarter, from 4,000 crore to 7,000 crore and back to 2,000 crore. Right? You got it? So these are accounting, and accounting cannot be removed or added. I mean, the profitability cannot be vanished, but it can be transferred from one quarter to another quarter. It could be preponed, it could be postponed. For example, we had to take some money from few customers, or we had to sell few products to our customers, and order was placed by the customer on 30th March. What we said, friend, this quarter we have made enough sale, let's do it. I'll be sending the product right now, I'll be dispatching right now, but I would be billing it on 1st of April, after 2 days. So this particular part of revenue moved from last quarter to next quarter. In the another way, the sale we were supposed to do next quarter, means on the 1st of March or first week of next quarter, was preponed on the 31st March itself. Right? So this accounting can be modified a little bit, tuning the timing. We cannot say that we will not be showing this revenue in the books at all. We will be showing, but sometimes later and sometimes earlier. So why do they do this? To affect the share price. Why? Are the promoters also involved? Yes, sometimes. Sometimes. Are you getting my voice? I think network problem is there. I cannot see you moving.